Hello, welcome to the Market Carver for February 17th. I'm Adam Harter, Chief Investment Officer, Financial Enhancement Group, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. And thank you, Andrew. I'll just say it here for a wonderful job last week, you and Grant. I got last week's Market Carver is one of the first things I did when getting back to the office this week.
Yeah, we had a lot of fun. Grant did a great job. He's always super personable and brings a great insight. I used to work next to Grant in the Indy office when I used to work in our location, and it's always good to be able to talk with him. And I think he did you well replacing you, but definitely glad to have you back and hear what you think about what's going on in the market these days.
Yeah, well is a nice way to put it. He's far better with a microphone, and I'm fine with that. That's all good and well. And I was happy to see the risk barometer talked about, and that's important because we had some discussion at this week's investment meeting too around the risk barometer. When we have some market turmoil, it is an important thing to come back to, and one of the things just to come home and continue to hammer on is we're often looked and asked, are we seeing a change in the risk barometer yet? And it's a good reminder that we did not build it and design it to really get every bob and weave and all these smaller minor moves in the market. After all, you told us this week it's basically the S&P 500 has gone nowhere since October. And so we've not really seen an environment for a significant shift. So we might come in one day and find a defensive risk barometer, but so far we've not signaled to that heavily defensive environment that if you happen to click and watch last week, you saw Andrew describe so eloquently. We're going to talk about the S&P 500 earnings. Of course, I come back and fundamentals kind of my beat, so we're gonna hit that off and from a longer term perspective. Then look at energy versus tech and what sector rotations can do, and then geopolitical events back on people's minds, and has been for some time with Russia. And Andrew always does a good job of bringing some context home with these events, and we'll share those with you. But we'll start with earnings. And look at the S&P 500 over a long period of time. This goes back to the early 70s. If you would expand and drag this chart on back, it would show you the same basic trend. That purple line is the long-term trend growth of the S&P 500. So that's really the first and centerpiece of this chart. And to see that the long-term average has been a 6.5% growth rate over time. I think that's an important thing to come back home to. When you ultimately invest in stocks or the S&P 500, the main thing that's going to pay you over time is that growth in earnings. When you enter the market, you're going to pay a multiple for that earnings, whether it's $15 a share or 20 or 10, whatever it may be. You're going to pay a multiple, and then when you sell, you're going to get a multiple. But over the long period of time, what will drive the increase in value is earnings, and 6.5% has been that streak. And so when we establish that trend, we can see from time to time the stocks, just like the economy, are cyclical. Sometimes we're above trend and we're doing really well, and often that goes along with the economy, which you can see in the gray bar recessions, which are often what tears earnings down. And where we are right now is quite a bit above trend. Corporations have done so well over this cycle, especially the past 12 months or so. Profit margins have just soared to such extraordinary levels. What we see is an earnings level that is far above trend. Now, that doesn't mean that we got to have a recession right around the corner to bring us back to it. But what it does mean is that we should moderate our expectations that earnings continues to just blow away the doors. And in fact, that's what we see from a lot of earnings reports here. To see them settling down and not growing as rapidly would be quite the baseline assumption. I know, Andrew, this is not your beat, but you follow everything too. So anything you want to add 2 cents wise fundamentally into earnings?
If my parents taught me anything, it's don't wade into a pool that you're not familiar with. And so I'm gonna trust you on the earnings side. Yeah, I'm more of a price guy. I follow tickers, not companies, and so that's why it works well with us, where you really get into the meat of the earnings, and I stick with the price stuff. So I won't offer an opinion on a topic that's not my wheelhouse. So I trust your guidance here.
Yeah, fair enough. But I don't want to let anybody be fooled. You were as well as aware of I was that during this quarter, we've heard a lot of guidance that companies don't have a good outlook. But yeah, so one thing I mentioned in there is that you enter into the market and you exit based on a multiple of those earnings. And that's really the next chart here is just to reset where we are in terms of evaluation, because over the long term, it's that growth in earnings that provides you a return. But any given day, any given year, or even a shorter term run of years, all that really matters is the multiple, how much people are paying per share is really what moves things around, especially on a shorter term basis. And so even though we have a muted expectation of earnings growth, that's not so bad if you're at a place where valuations are so low that it gives you a little bit of a cushion because you're entering at such a low level. That, of course, has not been the case as of late. So one of the questions is we've seen a little bit of softness in the market. What has that done for valuations? And this is the S&P 500 forward ratio that, to me, if I had only one fundamental indicator, this would be a candidate. It may not be the sole indicator, but it's certainly a candidate. But it is the price people are willing to pay for an earnings of the S&P 500 over the next 12 years. And it goes back into the mid 90s and into the late 90s where we saw just the epic bubble of all time. Here recently, we did challenge those levels, but not for very long. We have seen a strong run of earnings growth in the market, which is, so if you see, this is price to earnings. So earnings is the denominator. So a strong run of earnings pushes this valuation measure down. And all it's telling us is that we still are at a little bit elevated. We're not at a crazy level like we were just a few months ago. A lot of that noise we had to filter out because of the rapid adjustments we saw COVID related. But putting these two things together, the summation is the same. We don't expect the earnings to drive a whole lot of value over the next, let's say the near term, 18, 24, 36 months. Wouldn't expect a lot of rapid growth over that time frame. And we certainly don't have a tailwind from the valuation perspective. So where we wind up on that multiple is anybody's guess. But it's safe to say that somewhere around here would be reasonable. And I won't even ask you to chime in on that one, Andrew. So
Well, the one thing I would add there is I think when we look at it, we see the chart that's come down. Like you said, that the PE ratio has softened a little bit. And I think what it kind of likens it to, a lot of people are going to Florida right now, getting that Florida sun, trying to get warm after it's been in single digits here in Indiana, is we kind of went from where valuations were really, really hot. Like Adam said, it's not my area of expertise, but I do know how to read valuation charts. And we were at the point where it was like 100-degree valuations in the sense where it's not going to burn your face off, but it was getting pretty uncomfortably high. And now they've come back down to more the 90s or the 80s. We're not to the point where it's super bargain basement levels like Adam had mentioned, but we're getting where it's still pretty warm or still elevated valuations, but it's not near the scorching levels that we were at one point. And that's something we talked about on Monday in allocation meeting. And a lot of it's attributable to the fact that growth numbers have been so strong, that companies have been able to grow their balance sheets. They've had a really good last couple years so coming out of COVID with the boost from consumer spending and a lot of the fiscal stimulus and everything else that went into the market. And so that coming down of the multiple has been more attributable to the strength of corporate America, less so than the fact of what we're kind of seeing right now with some of that growth is starting to slow. And so we always want to be cognizant of what's causing the data to change. Is it that the top line or the bottom line of that ratio? Is it price that's starting to move too much, what I pay attention to? Or is it growth that's done real well, what Adam focuses a lot on?
Yeah, as always, it's a good analogy, and using the weather make it easy for people to understand. And that is the S&P 500. So that is the entire market of large cap stock. Something Andrew and I always pay attention to is we're not limited to that universe. We can find regional markets. We can seek out areas regardless of if we have 100-degree temperatures, and that's what we have been over the past year. We can find places that are attractive to at least visit. And so even though the overall market is still just, say, maybe not quite as hot, but lukewarm, we may even find some better places here. It's a more value-oriented of corners of the market that have been left alone for the past decade. So now we'll flip over and rotate to some more technical oriented stuff here, looking at energy versus tech. So Andrew, this is your chart. I'll pass it over to you for this.
Here we go. This now I feel kind of my more cozy blanket, a price chart. So what we're looking at here is two markets that have been kind of two ends of the spectrum of performance. We have technology versus energy. So as this black line goes higher, it's just telling us that the technology sector is doing better than the energy sector. When that line goes down, it tells us that energy is doing better than technology. So this is a long-term chart. This goes all the way back to kind of right at the peak of the dot-com boom back in 2000. And we can see it started out with where energy was massively outperforming technology. As that bubble was popping after the dot-com period, we started seeing tech stocks really were starting to struggle. Energy started to rebound. Got in that point, if you may remember, when energy got up to $150, right kind of near the peak of the financial crisis. And then we started that rotation again where energy began to underperform and technology stocks did really, really well. And that lasted a really long time, just over 10 years, where technology has outperformed energy and that black line is going higher. And we got to the point where we started actually, technology made up all of its lost ground from that unwinding after the dot-com period, and they got to the point where tech had just trounced energy. And now we're starting to see a little bit rotation again back towards energy outperforming tech as that black line on the far right side is starting to come back down. You can see we've actually just started to break below that key point from that dot-com period. And it just, what the main takeaway from this chart and what I was talking about in our allocation meeting with it was, while energy has done extremely well, it's the best performing sector so far this year, up almost about 23%, while a lot of the other sectors are actually negative. That there's still, it's short term, it's very kind of stretched. The momentum of it stretched. Its performance has been so strong. But when we look longer term, there's still a lot of ground to be made up potentially from energy's rotation out of technology. So it's not to say that we'll see this line come all the way back down to kind of 2008 type levels, but it just really shows how underperforming energy had been for so long, and there's still that massive long-term pent-up potential for rotation that we could continue to see energy outperform here. As we start this week, energy is beginning to soften a little bit, trying to work off some of that overbought conditions because it's been such a strong performer, but it's continuing to be an area that we're going to be watching and looking for opportunities. Obviously, nothing moves in a straight line, but the energy and commodity markets are continue to be themes we're focusing in on, and think it probably will be the case for most of this year, at least during big chunks of it.
This was such an interesting chart that you shared this week, and here's why. To me, one of the first major things that I can remember being an aha moment getting into this industry was shortly after 2000 when I got into the business, and we used to use point and figure charts. For those of you that have been with us for a really long time, you may remember the Dorsey Wright X's and O's charts that we use. And Tom Dorsey was a great market commentator and posed a lot of interesting things. And I'll never forget him saying that at that time, tech was just coming off of its big run and had begun to bust. And he was just speculating. And he, being a technical oriented guy, he made no investment based on speculation, but was simply setting the context for how far things could move. And I remember him just saying, hey, it wasn't that long ago, because energy at that time was such a small piece of the market. It was 5%, something like that. And tech had grown to be like a fourth of the overall market, very reminiscent of what we have today.
Let's say, sounds pretty familiar.
Sounds very familiar. And he says, hey, I just want to remind you, it wasn't that long ago, really, that we saw the reverse of this. Technology was 5% and energy was 25%. He said, I'm not saying we're going back to that, but that's how much things can change over time. And at that time, energy was just beginning, and all throughout the 2000s, then we saw it not quite get back to that, just as he described, but energy continued just to have a long run at it. And so that set really the framework for me to kind of understand how sectors can really change their composition over time. And so it was really refreshing to see that and be reminded of that class, we'll say, from Tom Dorsey.
Yeah, it's been a very stretched rubber band.
Absolutely. So geopolitical events, last thing here, Russia, a lot of people's minds, and thankfully, at least as the time of recording this, seem to be backpedaling it from it. So this is one of the biggest challenges, frankly, we have in the business, because so many of the concerns that we get brought to us from you and from ourselves, because we pay attention to the world events as well, things that make sense to us that could be scary or maybe from a logical standpoint, may lead us to think that may produce some market turmoil, doesn't always happen. And so this was really a good source of information that Andrew brought to the table, and he's very good at doing that whenever we see turmoil, that we try not to react on them, because often, actually more usually than not, because our timing isn't going to be perfect, we'll make the wrong move. And this is just some good context, Andrew, that I'll let you paint the color for, on just how the historical context is not friendly for trying to make timing moves based on political events.
Right. So whenever we get big headlines, we have to remember the job of news broadcasters or magazines, it's to get your attention, to sell ads. They're trying to inform, but they have to sensationalize a lot of what they talk about and make it sound interesting, so you will watch or read or buy or click or what have you. And so we often get our emotions get going when we hear these headlines, and they sound pretty scary. We hear Russia invading another country, and we think that's going to send the market really lower. And sometimes it could. But we want to remember, whenever there's times of sensationalism, whenever there's these crises, breaking news headlines, we want to turn back to the data. And that's what I often try to do, and refocus the conversation. And so thankfully, we have market data for a lot of other geopolitical events. And so looking back at those, we can see, how did the market respond when we've had these events occur, whether it was bombing of Syria, the Boston Marathon bombing, U.S. terror attacks, different wars. And you can see it kind of listed here, going back to the 40s, all these different conflicts that have arisen. And we can see what was the reaction to the market. So you can see the total drawdown on average was about 5%. Some were obviously much larger, some were much smaller. And then looking at the next column over, we can see how many days did it take for the market to eventually bottom. On average, it was about 22. And then we can see the number of days to recovery. And you can see the biggest takeaway here is, yes, the market does often experience some type of drawdown, but the drawdowns have been pretty minimal. And part of the reason for that is, while they do make for very big headlines, breaking news stories, the actual impact to the companies that are being traded, and we often forget these truly are businesses, is pretty minimal. Something that's going on maybe in the Middle East isn't initially going to impact for in the long term a lot of U.S.-based companies. Yes, it's going to have impact for specifically on Russia and Ukraine, maybe the energy markets and some things there. And there's rippling effects to energy costs that flow over to maybe things of plastics, or a lot of fossil fuels actually are used to create a lot of different things we may not think of. But the overall impact to our economies is often pretty minimal when it's something that occurs internationally. Even if we look at some of the impacts that happen to our market from domestic terrorism, look at 9/11, one of the biggest attacks on U.S. soil. And the market response actually wasn't that large, and was recovered essentially within about a month. And that was after they had closed the stock exchange for several days. So we have a look at some of the worst geopolitical events that we've had. From a stock market perspective, they get digested pretty well, thankfully. Now, that doesn't necessarily mean that the market will always digest these types of events, and it will always just be a 5% decline, since that's what the average has been. But we often want to take things in measured steps and recognize that the market historically has done fairly good job of digesting some of these concerns. Now, there's other issues that Adam and I would probably point to that are maybe bigger concerns than what's going on over in Russia and Ukraine, that actually are more timely impacts to our market. And maybe we'll save that for a future market, Carver. But looking specifically at these geopolitical headlines, historically, the market has done a pretty good job at digesting them, and they become much shorter term focused events, and have not seen the market get cut in half as a result. And so we want to taper down our emotional impact, and recognize that the market and what's going on in the news aren't always interconnected.
Yeah, an excellent pointing to 9/11 there. I think that's great context, because when most of us think back to the early 2000s and what a terrible bear market that was, when we reference that period, most will say .com, but many will often refer to what happened back in 9/11. And that was certainly the notable event of our lives. But in terms of financial markets, it was a non-event. The Fed was tightening before that maneuver, breaking that .com bust, and fiscal belts were tightening. And so all those things were leading to a tight, maybe even head towards recession before we even got to that point. And as you said, by a market measurement, had recovered within a month. So that horrible bear market was not a 9/11 event. So good reference and good explanation as always, Mr. Andrew. And thank you to all you sticking with us for this week's Market Carver. schedule a meeting with us. This is our version of the Coinbase ad, although more static on the QR code. So feel free to scan and make an appointment or give us a call, 800-928-4001. And don't forget that we have a radio show that you can listen to over the airwaves on WIBC or wherever you get your podcasts. So thanks again and have a great weekend.